Welcome to The Explainer. Today, we're taking the financial modeling guidelines from CFI and Macabacus and turning them into an absolute blueprint for flawless model design. Look, if you spend your days building, reviewing, or really just relying on financial models to make critical business decisions, this is going to fundamentally change how you approach your work.
So, let's start by validating a painful reality we have all faced. You open up a sprawling, messy spreadsheet and you just feel completely lost. Have you ever built a financial model that literally became impossible to read? You start with the absolute best intentions, right? But before you know it, you're buried in hundreds of rows, nested formulas, cross-sheet references, and it all ends up in this terrifying cascade of reference errors that even you can't decipher a week later. It is frustrating, it's incredibly time-consuming, and worst of all, it introduces a massive amount of risk into the equation.
Okay, here's our roadmap for this explainer. First up, the common mistake. Second, the reverse approach. Third, modular building blocks. And finally, key model drivers. Let's jump right in.
Section 1. The common modeling mistake. We really need to start by examining the trap that almost every financial analyst naturally falls into when they're handed a pile of data. It happens to the best of us, and it all traces back to how we kick off the design process. Most modelers use this highly intuitive but ultimately flawed linear approach. Basically, they start plugging in all the available inputs, they calculate sequentially, and they just kind of hope they reach a useful output at the end. And hey, it makes logical sense, right? You get your data, you drop it into Excel, you start doing the math, and eventually, boom, you get an answer. But this exact linear path is what leads straight to those spreadsheet nightmares we were just talking about.
The crucial takeaway here is that this sort of data dumped default leads to overly complex models where the sheer volume of noise just totally drowns out the actual business insights. When you start with inputs, human nature kicks in, and you tend to include every single thing you have simply because, well, you have it. And the result? A bloated, super fragile model. What you actually want is a lean, agile tool that answers very specific business questions.
Moving on to Section 2, the preferred reverse approach.
To fix this bloat, we need a complete paradigm shift. We must design our models in the exact reverse order. Instead of starting with what we have, we need to start with what we actually need. You've got to begin by sketching out the dashboard. Ask yourself exactly what decisions and final performance indicators this model actually needs to support. Are you comparing a cash flow forecast to a budget? Or maybe you're calculating the intrinsic valuation for an acquisition. Honestly, before you touch a single cell on a spreadsheet, you should be whiteboarding the final charts, the graphs, and the summary tables that your stakeholders actually need to see.
And knowing your dashboard allows you to step backward and define the very specific outputs needed to feed it, like a valuation metric or a budget comparison graph. Think about it. If your dashboard requires an enterprise value, then your outputs strictly need to provide that number. Nothing more, and absolutely nothing less.
Okay, so once those required outputs are locked in, you can strategically build only the calculations absolutely necessary to generate those specific numbers. So you aren't just calculating things because you happen to know the formula. You're building a highly targeted bridge from your underlying data directly to your required output. Finally, this backward journey leads us all the way back to the inputs, ensuring that every single data point we type in serves a clear, predefined objective. Look, if a piece of raw data doesn't eventually feed into your dashboard, it just doesn't belong in the model, period. This strict discipline is exactly how you keep your models lean, clean, and highly functional.
All right, Section 3, modular building blocks.
Now that we've got the philosophy down, let's look at the practical anatomy of your workbook. So instead of one massive, never-ending sheet of continuous calculations, you need to compartmentalize. Think of it like building blocks. You break the model up into reusable, standardized modules, things like working capital, depreciation schedules, or income taxes. The real beauty of this is that once you build a really great working capital block, you can just save it and reuse it in your very next model. It makes your work way faster, infinitely easier to audit, and incredibly consistent across the board.
And by working backward and using these blocks, we completely avoid the temptation to add every piece of available data. It calibrates the exact right level of complexity where it actually matters. It's dangerously easy to build a model that is either way too simplistic to be of any real use or so intensely complex that it basically requires a PhD just to update it. But this modular, dashboard-first strategy naturally filters out all that extra noise, ensuring your complexity is optimized perfectly for the task at hand.
Which brings us to Section 4, identifying key model drivers.
This is the engine of your financial model. We have to separate the signal from the noise among our required inputs, because even after trimming all the fat, not all inputs are created equal. You might have hundreds of inputs, sure, but only a small handful actually qualify as true drivers that dictate the success or failure of a business. A driver has to be two things: highly material to the final outcome and highly volatile. If it's material but it never changes, well, it's just a static input. And if it changes constantly but barely moves the needle, that's just noise.
For example, let's look at a corporate tax rate. In a stable country, that's just a standard input. But in a region with high political uncertainty, that volatility makes it a massive driver. You wouldn't waste your time stress testing the tax rate in a highly predictable economy, right? But if the local government there is rewriting tax laws every 6 months, suddenly that tax rate is the exact lever that could completely make or break your entire investment thesis.
Similarly, identifying drivers requires some really deep business knowledge. The price of gold is absolutely a driver for a gold mine, but silver? Not so much, if it only makes up a tiny fraction of their sales. This is exactly why financial modeling isn't just about the math. It's about deeply understanding the core operations of the business. You have to step back and ask, what actually matters to this specific company's bottom line?
We isolate these volatile drivers so we can properly stress test the model. We run base, best, and worst-case scenarios to see exactly how the whole business reacts to these specific fluctuations. Instead of totally overwhelming your audience by tweaking 50 different variables, you build a toggle switch for just these specific drivers. Then you can instantly show your stakeholders what happens if gold drops to $1,300 an ounce or if the tax rate suddenly spikes to 30%. This right here is where the model stops being just a static spreadsheet and transforms into a powerful, dynamic decision-making tool.
So, as we wrap up this explainer, I want to leave you with one final thought to completely reframe your approach to financial modeling. The very next time you open up a blank workbook and your hands hover over the keyboard to start typing in data, just stop. Ask yourself, before you type your next input, do you actually know what your dashboard looks like? Master this backward approach, and I promise you, you will never get lost in a spreadsheet again. Thanks for exploring this with me today, and hey, keep building with purpose.